Today, we're going to get into the difference between growth investing and value investing. Growth investing would be investing in companies that have significant upside potential, that are at a fair or even overpriced to their current intrinsic value, and you're looking for substantial upside. If you're doing this in the stock market, obviously things, are post-IPO, and you're looking for a significant innovation with the company. They're going to make an acquisition. Something is going to happen that's going to cause a significant rise in the stock or speculation on the stock. I've seen this with Tesla. We saw it with, there was a company that was Nikola that I was lucky enough to get into in 2020. They went public through a SPAC. And when they did the announcement, you kind of buy the rumor, sell the news type situation. It ended up being a nothing burger, but the speculation on the company being profitable drove price from, I think, pre-SPAC, it was like $7, $8, $9, $12, somewhere in there, all the way to at the peak. It was like a $77 valuation on the company. So that's a pretty significant rise on a stock in the stock market. Whereas value investing, you're looking for a company that is fairly priced or even undervalued in comparison to its intrinsic value. You're looking more for dividends, and you're looking to hold the stock for long term in order to continue to receive that income off of the stock. It's not going to be something that you're going to liquidate for the capital gains like you would on growth investing. So Warren Buffett and Charlie Munger, their entire careers were modeled after Ben Graham, who basically was the father of value investing. You're looking for stocks that are already publicly traded, they're liquid, but they're going to pay you a dividend, and they're fairly priced or underpriced in comparison to their intrinsic value. They're already well-established companies. The three companies that Warren Buffett and Charlie Munger really made their career on were Coca-Cola, See's Candy, and Geico. They just kept buying those companies over and over and over again. And some of the commonalities between, the delivery of their product cost them very little, or to manufacture their product cost them very little, and they sell it for significant margins, right? And because of that, they're able to pay dividends, which they're able to then reinvest into other opportunities or continue to double down on that stock. And they rode that horse until, Warren's still alive. Charlie just passed away. Some of the, to their credit, some of the best investors over the last decade, really outperforming pretty much anybody else over the long term. They had an average of like 20% per year. They made multiple people billionaires and millionaires along the way. Just a fantastic story. That's consistency over a very long period of time, continuing to double down on the positions that they know about. And that kind of speaks to diversification. Also, I wanted to mention that caveat in here. A lot of people talk about wealth management and diversifying your portfolio after you've made your wealth. But if you have core competencies, that tends to be the trunk of the tree that you continue to invest in. And that's really where they just continue to double down. They found those three companies, and once you get over certain thresholds, you can't buy anymore. And so they had to diversify further than that. But if they could have continued to just buy those three companies, I think they would have. So that's really what value investing is about. You're, again, looking for fairly priced companies or undervalued companies in comparison to their intrinsic value. And you're looking to receive those dividends as payments on a regular basis over a longer term period of time. And that works really well, especially for people that, have a longer time horizon. Maybe they're working a W-2. They have a career, they're in their late 20s, early 30s, and they've got another 20, 30 years before they plan on retiring. They want some cash flow distributions during that time frame where you can roll those dividends back in and continue to double down on those positions if you think that they're going to continue to outperform or perform as well as the market over the long term. On the growth side, again, you're looking for significant upside opportunities, arbitrage in the market. You're going to speculate there that maybe something will actually end up being overpriced in comparison to its intrinsic value. A lot of people would argue that Tesla at multiple points over the last couple of years has been one of those stocks where people have speculated that they're going to continue to appreciate. And then we've seen large pullbacks in that. Facebook is another one of those. One of those value investing opportunities I mentioned before. American Airlines in 08, 09, when they almost went bankrupt, they were a strong company, too big to fail. Very low stock price in comparison to where they are today. And people that got in on that opportunity made a lot of money. That would be one of those value plays. It's going to pay dividends, and it's underpriced in comparison to the value of the company. So just wanted to give you guys kind of the compare and contrast between those two to figure out maybe which one you would align yourself with, why one will be better than the other for you, and help you make educated decisions when you're investing. Again, everything on this channel is not investment advice, only for entertainment and educational purposes only. Always consult with your financial advisor before making any investment decisions. Personally, myself, I'll give you my 2 cents. I'm more probably on the growth side of things, but I'm also earlier in my career, right? I would like to amass wealth a bit faster, and you might play both sides of the fence. You might have something that has structured income with the dividends as a large portion of your portfolio, or maybe a smaller portion of your portfolio, and then you're making bets on things. You're just going to have to be aware of the tax implications on both sides. So the capital gains that you're going to be getting on those growth opportunities, if they are short-term, they're going to be taxed as income. You want to make sure that you're doing this and structured the right way. You have a trading LLC. If you're going to be making trades inside of a year, be able to, get all the tax benefits associated with that. That's some of the stuff we discuss for Digital Ascension Group and our clients, and also in the mastermind. But hopefully this business has been insightful for you. Are you a value investor, or are you a growth investor? Why or why not? Comment below, and we'll see you guys on the next one.